let's be real, most people teaching SMC will massively overcomplicate things. There's a million and one different confluences which are thrown at you and just leave you very puzzled and confused. And it's probably why a lot of you are struggling to be able to step forwards with your trading, because there's no clear and concise plan. Well, we're going to go through just 3 of the basic concepts which I use in my trading, which ends up getting an average of 20% a week on Euro USD alone using the 15-minute time frame. So rule number 1 in my playbook is that you need to have clarity around the market structure. You've got to know what direction the market is most likely going to head in. I'm just going to demonstrate really quickly here what it will look like using some annotations, and then we're going to look at the charts to show you a demonstration as to how I mark out my structure to make sure that I'm going in the same direction as the overall trend. If you follow that phrase, the trend is my friend until the bend. Perfect. We just need to find a starting point and a push up. Price will pull back and it will push up again. Okay, so there's a few main things which have happened here. This could be a series of candles, or it could just be one candle per leg, or it could be a series of them. But what we've got is here we've got a starting point, which we can now class as a low because we've had some development. We can go to this area, which is a high. Then this becomes a swing or a swing low, but it's also a higher low. And the reason is that it's higher than this previous low, okay? And then what we get is we end up getting something called a break of structure, which happens right here, okay? So the break of structure was labeled by the previous high in this instance, okay? So this ends up being a higher high, okay? So higher high. Ooh, I didn't do very well at art at school. Higher low, and this is just a high, and that is just a low. Okay, so really quite simple when the market's going up, and then just exactly the same on the way down. You get a starting point, price moves down, price will retrace because that's just what it does, and then it will come down again. And this can go on for ages, you know, it can go for about 10 iterations in a row sometimes. So again, what we have is we've got a high here, and then we've got a low, and then we've got a lower high, and then we've got a lower low. And what we got during this was a break of structure. Okay, so this was the previous low until we broke the low and made a lower low. So in both of these instances, you can see that the market is trending. In this one, the market is pushing up because it has previously broken the structure, moving upwards, and this market is moving down because it's broken the structure, moving downwards. So I'm not going to go into too many concepts in regards to, you know, picking the trend change and where it's going to switch around, because it's not really relevant for this video. But we're just going to have a look at the charts now to see a very easy way on how I stay on top of my market structure with live markings. So let's go through a little bit of bar replay, but I'm going to demonstrate right here what I use. So I use the horizontal ray. So just check that you can see that. You can. So I used a horizontal ray, and I'm just going to use M15 CHoCH and M15 BOS. Now, I use these by essentially setting alerts. Okay, so I'll set an alert every time that M15 BOS goes off. I get an alert, goes through to my phone, goes through to my watch when I'm wearing the smartwatch. And it will also alert me on TradingView. So we're going to do a tiny little exercise which I would recommend to everybody. Now, as you can see, I am using the strong magnet tool as well. It just makes things easier to snap the lines on, and I've got a series of templates for BOS and CHoCH. Okay, so we're on the 15-minute time frame. Let's just go through a little bit on bar replay, but I would recommend everybody to do this. Okay, so we're not looking at entries or anything like that. We're just following structure. Okay, so we want to be trading in direction of BOS. Okay, so BOS is the pro trend. You always want to be going in the same direction as the trend. Now you can go with overall market structure. That's good. You need to do that. That is important. You can look at higher timeframes. That's more important. But to be able to track and trace the current market trend, you need to be going in the flow. So let's click on through, and we'll hopefully get some BOS and CHoCH so you can just see it. So straight away, we get a BOS, okay? So that first black candle came down and broke the BOS. Now, you can, if you want, just to keep track of it, just use a little trend line tool and just show where we got the breaker structure. So this little blue candle came in, and even though technically, you know, we've broken the low, it's not classed as a BOS, okay? A BOS A break of structure normally includes a bit of a pullback. So the next candle can't break the low, but in this instance, we've just continued the trend. Okay, so we'll just click along a little bit and get a couple of these on there. And this is all what you need to do. Just go back as far as TradingView will allow you to go, or Forex Tester, whatever you choose to use as your software, and just do this as an exercise and just get used to, training that part of your brain. Every time that you see it, mark it on. I can now move this and then click along. Then we get, CHoCH move. I do BOS and CHoCH differently, just so you're aware. So SMC is a little bit different from how I trade. So my BOS and CHoCH have not changed. We've just ended up bossing down again. Then we get CHoCH. So BOS moved up to there temporarily. That's all what we're doing. So I might as well just get the trend line, mark that on. So it's just showing the main market structure. So I know where I want to be going in regards to the direction of the trend. Okay, that dropped in quite quickly. So we got BOS again. CHoCH now moves to here. And all what we're doing is we're just following the trend. And that's it. And you can go back and do hundreds of these, and I would recommend it. It's all part of the game. You need to be practicing doing this. So now that we've got the basis of market structure put into place, let's look at part number 2. Part number 2 is looking at market imbalances, which is an absolutely critical part of my trading. Now, I'm not going to go into the details of what an imbalance is, but I'm just going to show you how to spot them. In order to understand an imbalance and kind of the constructs of it, I need to explain the formation of a standard candlestick. Now, a market imbalance is shown after 3 candles, but generally speaking, we need to understand the structure of the candles to see where the imbalance comes from. Okay, so at the start of any candle, so it doesn't matter what time frame you're looking at, you're going to start off with a very small little, just a line. This candle is forming at 1:30 in the morning if we look down here. Now at some point during this 15-minute time frame, so most likely right away, the candle is going to come down and it will appear red. Okay, so it's starting to move down. So this would be red right now. And then at some point during the 15 minutes, it's going to go all the way up to here and it will look like a really strong green candle with this little line at the bottom, which I'll explain in a moment. And then at the end of the 15 minute, it's going to close there. What it's done is it's left behind this little shadow or little wick. Okay, so we're left with the body, which is the green bit, and then the wicks, just to show you the range in which the price went during that time frame. Okay, now these wicks become really, really important for determining imbalances. Just to give that a quick recap, we've got the open, we've got the low, we've got the high and the close, and they're always indicated up here on TradingView, and with most of your brokers as well. You'll see the open, high, low and close, which is really important information. In the structure of a market imbalance, you'll have a second candle which forms and it continues in the same direction as to where that candle had closed. So this candle had closed here, we'd reached this high over here, and we've just drawn this on as no wicks either side. So when this candle formed, it started off as a little line, and then it just grew and grew and grew and grew and grew, and it closed there at the end of that 15 minutes. Now, this candle was created, okay? So again, it started off just here, price came down, it would have been a red candle at this stage, and then it worked its way up to here, and then it closed there, all right? So you've got the 3 candles in place. Now, a key part to my trading is determining where these imbalances are. Okay, I want to see where there is liquidity in the market. An imbalance shows you a lack of liquidity. It means that price is most likely going to run through that area into an area where there has been a big exchange of trades. Okay, so the imbalance is lining up the gap between the wick of there and the wick of here. Okay, so this would be the market imbalance. There's this little gap in the middle of this candle which shows the imbalance. Sometimes you can have it like this, and this wick could be, well, doesn't have to be a wick. Therefore, the imbalance in this instance would be from the wick of that candle and the top of that candle. Okay, so that's just a market imbalance. Now, I'm going to jump through on the charts and just start marking out a couple of imbalances for you, but then I'm just going to show you a quick trick which I use because sometimes I don't spot them. Okay, so just coming back down to what we'd started with our structure, I'm just going to mark out the market imbalances. Let's just jot a few of them on as price has gone past. Tell you what, we'll do it on bar replay again, just so we're covering the same areas. As you can see, this wick has come up and leveled out this one, so there's no imbalance there. This one has been leveled by that. This wick has been leveled by that. And we call that rebalance, okay? So they've been rebalanced effectively. So what we're looking at is a very balanced market. And then we've got here, we can snap that on. And then we've rebalanced again, price has come down. We're now left with a little gap here, so we could expect potentially that there's going to be a rebalance here. So a rebalance, just so we remember, is a closure of this gap which has been created. Okay, we've rebalanced. Okay, so again, we've rebalanced. And we're just going to click until we break with a clear structure break. Now we've been left with another imbalance right there, which got filled by this candle. Now there's another imbalance right here, okay, which has just been filled straight away. So that's been rebalanced. And then we got another imbalance right there. We got another one here, which has been refilled. And we'll leave it there because you get the point. So just looking at this, this is where the market imbalances are. Now, I don't trade from the imbalances. Some people in the SMC do, okay? I trade from order blocks, which we're going to come into very shortly. But essentially, you want to be able to mark out these imbalances and just understand where they are, because I believe that price tends to move beyond the imbalances to where previous orders have been placed, where there's been an exchange between buyers and sellers, which means that there's still buyers or sellers left in the market waiting to be tagged out by your trade, essentially rescuing them. So that's how I use imbalances. Now, just a little tip of what you can do. Now, as you can see, I don't typically use indicators on my chart at all. I like to have a nice, clean, naked chart set up, but I have used an indicator up here. It's called the imbalance detector by Lux Algo. Okay, so I've just changed the settings very slightly. I know some people will call them fair value gaps, but they're predominantly in stock trading rather than Forex. Opening gaps and volume imbalances. Okay, so I just keep all of those on because they're pretty much the same thing. And I've just made them a little bit, gray, so they stand out on my charts. So if I go back through, I should be able to see whether or not I've missed any imbalances. And as you can see right at the end, I have done, I've missed a few. But if I remove that, it should show as an imbalance. If I remove this one, there's an imbalance. This one, there's an imbalance. That one, there's an imbalance. That one, there's an imbalance. So it's helpful. It shows up on the charts as price is going through, so it helps you determine the next step. Part number 3 is my favorite. It's order blocks, otherwise known as trapped orders or blocked orders. Similar to the imbalances will show you essentially a big burst of momentum or a big burst of volume coming out of a particular area. Now, an order block is usually an opposite colored candle which has formed a little bit of like an apex or a swing in the structure, or it could be the last candle before the breakout of a tight range. So I'm going to draw you a couple of examples on here of what an order block may look like, and then we're going to go back to our charts and mark them out, and we'll place a couple of trades just to see how they do. So here we are again, able to use our logic of order blocks and market structure. So I'm just going to mark out a few areas which would be classed as order blocks or blocked orders that I would see. So we always just refer very quickly to the imbalances. Okay, so the imbalances just mark out where there's liquidity gaps. So essentially the order block is directly above there, which price came to. There was another one here. Okay, so I'm just going to mark out the order blocks, which price again came to short term. There was another one here, which very short term price came to. There was another one here, which was created, which price came to. And then up here, which price again has reacted to. And we're working our way down. So right there, and we'll just press this and see what happens. So there's quite a few imbalances being left behind, another order block being created. And essentially what we would be doing is placing trades off of these order blocks. Okay, so a nice tag into that one, come down, no imbalances left behind. There's a little imbalance here, another order block being created. See how it's working? I smashed through that one, came back up to retest that one again. So you can see essentially how I'm trading. Now I'm going to show you a live chart as to how I actually mark up my charts. I don't use all of this, all these markings. I tend to trade with a very clear chart. I don't like having everything marked on, but you'll just be able to see a few demonstrations as to where I could have got involved with the trades today. So I'm just going to show you exactly what my charts look like on a daily basis. Now I've got the screen split into 4 different charts, okay? So they're all looking at exactly the same thing, but I'm just going to explain them. So down here in the bottom right, I've got the weekly chart, okay? So I've got a much higher time frame view. All what I have marked on here is the order blocks, okay? I want to know exactly which direction the market's likely going to be flowing in from a macro time frame. Up here, we've got the H4. It helps me with the flow of the market. So I try to take trades in the direction of the H4, getting entries on the 15-minute. So on here, it's very clean. I've got the BOS and CHoCH lines as I described before, and I can see where the order blocks are. Okay, so there's one which I haven't got marked on just yet. So I'm just going to mark on here, and there's my H4. Okay, so realistically, I want to see the M15 on this chart come down to an order block in here, which I'm just going to mark out. And if I manage to take a trade from there, I'm going to be looking at something around about this, and I'm going to be targeting the top of the H4. Okay, so that's going to give me a nice 7R trade if it comes in. Now, I do drop down to an even lower time frame if I can, and I mark out on here where I'm going to be getting involved. So I'm just going to modify that, turn that into an M1. Okay, so I might be able to get an even better risk reward ratio. Did I just delete that? I did. So I'm going to see if there's a better risk reward ratio available off of that and take it up to the high. And there we go, get 11R. So that's all how I trade. There's another one just here, which, prices come into. It's not quite an order block. It's just an inside bar, which still holds its weight, especially with the time of day. So just another sort of hint. It's 1:30. New York had started. The next session is going to be Asia. There's not going to be much liquidity, which we'll go into in another video. So if you haven't already, subscribe, because it's going to be going into quite a lot of detail with several of my concepts to help you see how I trade. Now, if you follow these general rules of marking out the market structure, you mark out where the imbalances are, you're going to be able to see where the order blocks are. If you follow the trend direction with your entries and you target just BOS, just BOS on the same time frame or the higher time frame, you are going to get 20R per week on average over the course of the year. Some weeks you will have a very small loss. You might be down 2 or 3 trades. Other weeks you will get 70 or 80R, like what we got 3 or 4 weeks ago. It was phenomenal. So if this has been useful to you, you might want to watch the next video, which will show up somewhere on the screen. And maybe you want to join me in FTR using the links below, where I do have several strategies which you can use to be able to get the best out of the trading days available. Thanks for watching.